My name is Alani Nguyen, and I'm your finance consultant from the William Factory Small Business Incubator, and I'll be your mentor for this workshop. So before we get started to the slides, there's some words that you need to know, which is collateral assets, real estate, fixed as in like fixed property, fixed income, fixed expensive. I'm gonna have worthiness liquidation, with risk. We're gonna talk about secure loans and unsecured loans. We also gonna talk about finance credits, revenue statements, personal banking, commercial banking, debt to income ratio. Before we get started to learn more about business finance, from business to personal, let's talk about like how many of you know about finance? Like, do you know anything about personal finance versus business finance? So pause this video and think about it until you have your answer. There's no right or wrong answer, just think about it, and then we'll go on. So let's talk about business finance. So business finance is focused on managing the financial resources and activities of a business entity. It involves acquiring funds for business operations, making investment decisions, and ensuring the financial health of the organization. Let's give an example. Equipment purchases, staff payrolls, gross revenue, business tax owned. Now let's talk about personal finance, which involves managing an individual's or a family's financial resources. It includes budgeting, saving, investing, and planning for personal financial goals. Let's think of an example. Personal income, personal credit, savings for retirement, personal investment as in stock markets, 401k, personal assets as in house, cars, and artwork. Now let's talk about consumer credits. So what is a consumer credit? So a consumer credit is individuals buying goods or service on credit, paying for them over time instead of upfront. It's like offering a payment plan or credit card options for customers to make purchases. So let's talk about consumer loans. There are a few types of consumer loans, such as auto loan, which is a secure loan that consumers can use to buy a vehicle. Now let's talk about cash advance. It's a short-term loan offered by your credit card issuer. Now, a personal credit card is like MasterCard, Visa, Amex store involving loan account. Like, let's say Macy's, they have a credit card you use to shop at Macy's or any store that's related or attached to Macy's. Now let's talk about student loans. I think a lot of people who went to college know about this. So a student loan, a loan that is for educational purposes, like mainly college. Let's talk about credit score. I think a lot of people know about this because you use credit cards all the time. But let's talk about credit scores. So what's a credit score? So a credit score is a numerical representation of an individual's creditworthiness. So what are the effects of it? So one of it affects the payment history, as in, are you paying on time? Are you paying the minimum amount or more? Another effect would be credit utilization, as an amount of credit use. This is usually defined as a percentage of debt allowed. For example, if you have a total credit card due an amount of $4,000 and a limit of $8,000 in credit, your utilization rate is 50%. Another thing will be affect is the length of credit history, as in how long have you sustained your credit card. And also another effect will be types of credit use, as in credit card, home equity, auto loans. Another thing I think would be new credit accounts, as in open and close account. Another thing, the last thing will be student loans, as in how to maintain healthy student loan credit. So right now, let's talk about why does consumer credit score matter. So one thing why it matters is the loan approval, as in like higher credit scores increases the likelihood of loans approval. Another thing will be interest rate, as in better scores may result in lower interest rate. Another thing will be financial opportunities, as in affect eligibility for credit cards, mortgages, and other financial opportunities. I think would be responsible credit usage, as in avoid like maxing out your credit card and manage debt responsibility. Finding monitoring a routine to check your credit report equals a good habit. Okay, let's now talk about business credit. What is a business credit that everyone should know when you open your business? So a business credit refers to a score a rating agency provides to assess the ability of a business entity to borrow funds or obtain goods and services in credit. There's a few notes that I wanted to say. Usually a few banks will use agency credit scores for a business loan. Each bank will conduct a review of a business financial statement to determine the amount of loan, interest rates, and fees. There's one thing you want to be cautious about is that it is likely that money spent on a business credit report will not enhance your ability to obtain a commercial loan. Let's talk about commercial loans and types. There are 4 types of loans. One would be term loans, as in fixed term loans for specific business needs. The second type of loan would be lines of credit, as in revolving credit lines for ongoing operational expenses. The third thing about it we have is equipment financing, as in loans for purchasing business equipment. And the last thing we have is commercial real estate, as in loans to business to buy or improve fixed property. There are 3 things to know about a financial statement for business, as in 1, income statements, 2, balance sheets, and 3, cash flow statements. And if you have any questions about financial statements, we can have one-on-one sessions coming up, or you want to personally have a one-on-one with me, we could talk about it. We could also prepare your questions based on the session you have. We talk about the 3 roles of financial statements. Let's talk about what they are and what they use for. So the roles of financial statements in business credit worthiness. So for income statements, what it is shows revenue, expenses, and profits over a period. A balance sheet, it provides a snapshot of a business financial position that includes accounts receivable, accounts payable, equipment value, and possibility of intellectual property. And the last thing is, as for cash flow statements, it reflects the inflows and the outflows of cash. It's going to be a little heavy. With this slide, we're going to talk about financial statements and credit approval. Let's talk about lenders evaluating financial health. And what it is lenders analyze financial statements to assess the business stability. There's banks that look up 3 consecutive years of net income. This can be based on, for clarification, as a commercial or versus a personal loan. The objective is to avoid using personal collateral for business purposes. Usually net income is after taxes, how much the business earns within the year, and if it's negative, you lost money, which means you'll have to put your money in the business, and if it's positive, you'll make money. The goal of the business is to make profit, and banks want to see your 3 consecutive years of net income. Bankers really want to know if you're making money for your business. You want your personal and business finance to be handled responsible. Now, let's talk about debt service coverage ratio, as in ratio used to assess a business state ability to cover its debt obligation. So example 1.2 ratio means you need to have 20% more income than the amount of bank payment due. For example, if the monthly bank payment, which is the principal plus interest, is, let's say, $2,000 monthly, the bank will want assurance the business has $2,400 available monthly in available cash to make the bank payment. For the debt ratio, is the amount of money that the business having available in the amount to make the loan payment. From the banker's point of view, they want extra cushion money. From a business point of view, this is an opportunity to prove to make net income. And there's the importance of accurate reporting. An accurate financial reporting builds trust within the lenders. Alright, let's talk about the importance of financial reporting for obtaining business credit. There are 2 things about the importance of financial reporting to obtain a business credit, which is 1, lender's confidence. And usually for a lender's confidence, you want to be accurate to the financial statements build and confidence in lenders. Another thing will be you have to demonstrate transparency and responsible financial statements management. Now, for the risk assessment, you want to know that lenders use financial statements to assess the risk of lending to a business. And another thing is that you want to help determine interest rates and loan terms. Each bank will determine the lending to a business based on financial statements. So on this last slide for this recording, we're going to talk about collateral differences. There are a few things of collateral differences. One would be collateral in consumer loans, which is a collateral is an asset that a borrower pledged to a lender to secure a loan. Another thing would be account receivable, which is total amount due to the business. Another thing I think people will have is equipment and vehicles, which is your assets and depreciation. If you use a car, you have to calculate how much you use. You can put your vehicle as collateral. But most of the time it'll be repossessed unless you're good at negotiating. Now let's talk about business bank account, which is a liquid, generally like personal account. Banks want a judgment and you'll look through a priority. Now, personal loans. Another one thing about personal loans, which is spouse. So if you don't pay your personal loans, then your personal loans will go after your spouse to pay your debt. Now, let's talk about home equity, which is technically land, and for automobile would be vehicles. And for last thing would be personal bank balance, which is the 401k example. I think that'll be all for the slides and sessions for this video. Thank you for watching this video. This video is made possible by WSMA. Stay tuned for more content from the William Factory Small Business Incubator.